Do you believe in ghosts? Because right now, the global economy is being haunted by something we haven't seen in almost 20 years. Imagine looking at a graph that tracks the financial heartbeat of 2008, right before the crisis that destroyed millions of lives and wiped out $15 trillion in wealth. Now imagine overlaying today's economic data on top of it. They match almost perfectly. This isn't conspiracy theory. This is hardcore pattern recognition, and the pattern is screaming danger at volumes we can't ignore anymore. We're seeing a specific sequence of debt explosions, interest rate spikes, and frozen credit markets aligning in ways that economists thought were impossible to repeat in our lifetimes. The yield curve is inverted deeper than it's been in decades. Corporate debt is at record highs that dwarf anything we saw before. Credit is tightening faster than during the 2008 collapse. Consumer confidence is tanking month after month. These aren't just similar to 2008. In some cases, they're statistically identical. But here's what terrifies me more than anything. While the symptoms look the same, the disease has mutated into something far more complex. Is 2026 just an echo of the great financial crisis? Or are we staring at something far more dangerous, something the world has never dealt with before and isn't prepared to handle? Welcome back to Crayon Finance, where we draw the truth about money in ways anyone can understand. Today, we're doing something different and honestly pretty scary. We're taking the vital signs of our current economy in 2026 and placing them directly over the autopsy report of the 2008 financial crisis. What we found should terrify you, but it should also prepare you. Let me start with a story about how nobody sees these things coming until it's too late. In 2006, the party was raging. Nobody saw the disaster approaching. Sure, there were whispers in dark corners. A few contrarian analysts noticed something odd happening in the data. Housing prices were climbing too fast, defying every historical pattern. People with no income, no job, and no assets were getting $700,000 mortgages to buy houses they could never afford. Banks were taking these toxic loans, packaging them into fancy financial products with complicated names, and selling them to pension funds as safe investments. But the mainstream narrative was crystal clear and repeated everywhere. The economy is strong, housing always goes up. We've entered a new era of permanent prosperity and growth. Then, in 2007, something invisible broke deep in the system. The yield curve inverted, which means short-term interest rates went higher than long-term rates. It's the bond market's way of screaming that the future is broken and dangerous. Banks started to panic quietly behind closed doors. Credit froze like water in winter. And by September 2008, the entire global financial system was on life support, requiring trillions in emergency intervention. $15 trillion of wealth evaporated into thin air. 9 million Americans lost their homes to foreclosure. Unemployment doubled almost overnight. The stock market crashed by over 50%. It took more than a decade for the economy to fully recover, and many people never did. Now let me tell you what's happening right now in 2026 and why it should make your blood run cold. Total U.S. debt has exploded to levels that make 2008 look like a child's piggy bank. We're talking about over $70 trillion when you count government debt, corporate debt, and household debt combined. That's more than 2.5 times our entire GDP. Interest rates have been hiked aggressively over the past few years by the Federal Reserve to fight inflation, and they're staying elevated much longer than anyone expected. The yield curve? It's been inverted for one of the longest periods in modern history, longer even than before the 2008 crisis. Banks are tightening lending standards at the fastest pace since 2008, making it harder for businesses and consumers to borrow. Consumer confidence is dropping month after month as people feel the squeeze. Business investment is slowing dramatically. Are you starting to see the pattern emerge? Good, because it gets significantly worse from here. Let me break down the three horsemen of this economic apocalypse. First horseman, the yield curve inversion. In a healthy economy, if you lend money to the government for 10 years, you get paid more interest than if you lend for 2 years. That's basic risk and time value. But when the curve inverts, when short rates climb higher than long rates, it signals something terrifying. It means investors believe the near future is more dangerous than the distant future. In 2007, the yield curve inverted 18 months before the crisis hit. It was the canary in the coal mine. Fast forward to 2026. Following the Federal Reserve's war on inflation with the fastest rate hikes in 40 years, we are experiencing one of the deepest yield curve inversions in recorded history. The bond market is sending the exact same distress signal, and here's why this matters. When short-term rates are this high, it breaks the banking business model. Banks borrow short-term from depositors and lend long-term to businesses and homeowners. The difference is their profit. When that math doesn't work, they stop lending entirely. And when banks stop lending, everything stops. Businesses can't expand. Consumers can't buy homes. The gears grind to a halt. Second horseman, the debt bubble shift. Here's where the story changes dramatically. In 2008, the problem was private sector debt. Joe the plumber had a subprime mortgage he couldn't afford. Sally the waitress had maxed out credit cards. The banks bet trillions that housing prices would never fall. When they did, the private sector imploded. But look at 2026. The debt hasn't disappeared. It just migrated. Today, government debt is over $35 trillion and climbing. Corporate debt is at all-time highs. Companies borrowed massive amounts when rates were near zero during the pandemic. They issued bonds at 1 and 2%. Now that debt is maturing, now they have to refinance at 5, 6, or 7% rates. Imagine your mortgage payment tripling overnight. You'd be bankrupted instantly. That's what's happening to America's balance sheet right now. This isn't a housing bubble. This is a sovereign debt crisis combined with a corporate refinancing nightmare. The bubble is bigger, but the walls are made of treasury bonds and corporate debt that everyone assumed was safe. Third horseman, the credit freeze. This is the invisible killer. In normal times, the U.S. government borrows money cheaply because it's the safest borrower on earth. Risky companies pay significantly more. The difference is called the credit spread. In 2008, banks became terrified to lend to anyone. Credit spreads exploded. Companies couldn't borrow money to make payroll. The economy seized up. Right now, in 2026, we're seeing this exact pattern repeat. Banks are worried about their balance sheets. They're sitting on losses from bonds bought when rates were low. They're terrified about commercial real estate collapsing as offices sit empty, so they're slamming the vault shut. Small businesses can't get loans. Consumers are seeing credit limits slashed. This creates a vicious cycle. When credit tightens, businesses can't grow. When they can't grow, they lay off workers. When workers lose jobs, they default. When defaults rise, banks tighten even more. It's a death spiral we've seen before. So, is the world ending? Are we repeating 2008? Here's the critical twist nobody's talking about. The pattern is identical, but the patient has fundamentally changed. In 2008, the banks were holding all the toxic waste on their balance sheets. They were completely insolvent. Lehman Brothers collapsed. Bear Stearns was sold for $2 a share. The entire banking system needed massive government life support. Trillions were injected to prevent collapse. Today, the banks are in much better shape. They have more capital reserves. They passed stress tests. But now the government itself has terminal cancer spreading through its balance sheet. U.S. debt to GDP is higher than after World War II. We're spending more on interest payments than on national defense. And here's the nightmare. In 2008, the government could bail out banks by borrowing cheaply and printing currency. But in 2026, who bails out the government? The answer is nobody, which means the only option is the printing press. This is where things get dangerous differently than 2008. Back then, we got brutal deflation. Asset prices collapsed. Houses lost half their value. Stock markets crashed 50%. It was brutal, but cash became king. If you had money in 2008, you could buy assets for pennies on the dollar. But today's crisis is structurally different. Because the debt is sovereign, the solution won't be deflationary collapse. It will be aggressive inflation. They won't let the system collapse. They can't afford to politically. They'll print money. They'll monetize debt by having the Fed buy treasury bonds. They'll devalue the currency to lighten the debt burden. You might not see housing prices drop 50% like 2008, but you might see the dollar lose 50% of its purchasing power instead. This is the ghost of 2008 wearing a different mask. The pattern says something must break. The physics of debt and interest rates say something has to give, but the symptoms will present very differently. We're not facing sudden deflationary collapse. We're facing slow-motion inflationary grind, a gradual destruction of currency value while asset prices stay nominally high but become unaffordable in real terms. Here's the question that matters. What do we do when history rhymes but refuses to repeat? The 2008 pattern is undeniably here in the data. Every indicator is flashing the same warnings, but don't prepare for the last war. Prepare for this one, which plays by different rules. This means cash under your mattress loses value while sitting still. It means tangible assets, real estate, commodities, businesses that produce actual goods become the lifeboats in a currency storm. It means recognizing we're in completely uncharted waters. Nobody has ever successfully navigated a sovereign debt crisis of this magnitude in the world's reserve currency, while simultaneously fighting inflation and geopolitical chaos. The 2008 crisis gave us a playbook for deflationary collapse. This time, we're writing a new playbook for inflationary destruction in real time. And here's what keeps me up at night. We won't know which scenario unfolds until it's already happening. The 2008 crash took 18 months from warning to collapse. We're already 24 months into the warning phase. Stay informed. Question official narratives. Prepare for multiple scenarios. This isn't the last time we'll need to decode these signals together. Every week, we're tracking this pattern as it unfolds. Hit subscribe so you're prepared, not panicked, when the storm arrives. This is Crayon Finance, where we draw the invisible lines between data points the mainstream misses. Stay solvent, stay smart. This is for educational purposes only and not financial advice.